Okay, we've got quite a full crowd here, 115 people and counting. That's terrific. This is a very important topic, and I'm glad it's generating the interest that it deserves. We're going to be talking today about equitable AI in finance. This is an event hosted by Chicago Booth Center for Applied AI, and I'm the faculty director for that, and Emily Bembenek, who's on, is the executive director. And we're very excited to be able to bring this to you jointly with the Rustandy Center for Social Sector Innovation. For those of you who are interacting with us for the first time, let me tell you about these two centers. The centers in general at Chicago Booth are in many ways the lifeblood of the entire institution. They coordinate between faculty and students, but also importantly, the broader community and alumni of Booth. And that's what events like this are for. The Center for Applied AI tries to fill a hole that I think is pretty big in the world, which is the gap between those people who engineer solutions, AI solutions, and the people who have problems. I think we've tried to focus on the fact that engineering alone isn't going to help us design and build good AI products. For those of you who aren't familiar with the Rustandy Center, it's really the social impact hub, and it's committed to tackling complex social and environmental problems. It does a wide variety of things. It promotes innovation, research, and I would encourage you all to read more about both of these centers. So with that aside, let me just dive in. In today's event, we're going to be talking about AI and finance. And the reason I am super excited about this event is because if we've seen anything, that we've seen that one of the biggest forces for good and bad in all of society is finance. Finance is responsible for helping people accomplish all the goals they want. It's also responsible for massive crashes and reinforcing inequities. Finance is an incredibly powerful tool and has done a lot of great and good things in the world, but can also do bad in the world because of its power. When such a powerful tool is combined with another powerful tool, which is AI, we have, I think, all the ingredients for doing something truly transformative. We also have all the ingredients for doing something quite dangerous. And so I think this area requires a tremendous amount of attention. And we're excited, I'm excited to have four really exciting people discussing this. And the person who will really be leading the discussion is Ingrid Tierens. She's managing director of data strategy at Goldman Sachs. Ingrid, I've known Ingrid now for, I think, about 3 years. Last time we met was when we could actually travel in her office. Ingrid has thought a lot about data and is one of the most thoughtful people about data and finance that I've ever met. So I was thrilled we could have her join to moderate this session. Thank you, Ingrid. And we also have 3 just really interesting people to guide the conversation, to be part of the conversation. Jay Budzik, who's Chief Technology Officer at Zest AI, Anna Costello, one of my colleagues at Booth, who's a professor of accounting, and Sam Taussig, who's VP of Product Development and Special Projects at American Express. You can just see from the names, from the affiliations of the people involved, this is going to be a very high-level, interesting conversation. And so I'm very much excited to listen in. I also want you to share questions. In my experience, the conversation is only 50% of what you get out of these things. The questions of the people in the audience is the other 50%. So there'll be time at the end to address some of your questions. But don't wait till the end. As things go on, as questions come to mind, just go to the Q&A tool within Zoom, and that'll just let you get it off your chest while it's fresh, and we'll try to get to as many questions as time allows. So let me just stop talking now and hand it over to Ingrid. Thank you all for coming, and thank you, Ingrid.
Thank you so much for the generous introduction, Sendhil. So before we start delving in here, maybe setting the stage a little bit, when we talk about AI today, we will really be using a broad definition of artificial intelligence. So really the idea of we use computers to simulate what humans do. So whether that's reasoning, learning, problem solving, it may include, when we reference it today, it may include all sorts of applications of AI, could be NLP, expert systems, various ways of learning, could be supervised, unsupervised, etc. So we're really not, zooming in on anything in particular here, use the broad application. As Sendhil mentioned, there are many use cases for AI in the financial services industry. You can think about different ways of measuring credit, detecting fraud, tracking pay. You can sift through millions of execution data to see if you can come up with potential market manipulation, etc. For today, and given the background of the panelists here, we will really be focusing primarily on the application of AI in consumer and small business finance. So let's kind of start a little bit by focusing on the good. Sendhil already gave the heads up. There's the good, the bad, and potentially the ugly. AI has allowed us to make a lot of progress within financial services. So it's probably a good idea to start off by giving some perspective. So Anna, will turn it to you first. If you can give us some idea of evidence where AI has really been a force for the better. And, again, everything is relative to compare that against where we were pre-AI days.
Sure. Well, first, it's a pleasure to be part of this panel on such an important topic. So let me give you a little bit of a historical perspective here. If we look, historically at different lending models through time and how that has changed the lending landscape, it's definitely true that with the advent of new technologies in finance, we've seen, some wins. We've had some wins here in terms of expanding access to credit, and reducing fees and interest rates for underrepresented groups. So let me take you back to what I'll call the traditional lending model, where you have face-to-face lending. You have a borrower and a lender in the same room, and it's really the human being that's making that accept or reject decision. If we look at the data under this traditional model, it's pretty clear that underrepresented groups face disadvantages relative to, say, white male borrowers, in that, they pay higher fees, they face higher interest rates, higher likelihood of rejection. And at the business level, minority-run businesses also get fewer small business loans. What's important is these patterns in the data persist even when we control for differences in economic characteristics across these two groups. And so, holding credit quality constant, we still see that minority groups face these disadvantages. And so really what's been concluded in that literature is that lenders do, in certain cases, discriminate against minorities when making lending decisions. So now let me talk a little bit about some good news. When we look at, more technology-based lending, what I'll call fintech lending, we do see some improvements in terms of reducing that gap between minority groups and non-minority groups. So a recently published study actually finds that fintech lenders discriminate about 40% less than face-to-face lenders in loan pricing. And they actually don't discriminate at all when it comes to the accept or reject decision. So those are pretty big wins that we can point to in the technology-based lending space. There's also a really cool recent study that looks at lending at the onset of the COVID pandemic, and specifically distribution of funds through the Paycheck Protection Program. And what the authors find is that Black-owned businesses are much more likely to obtain their PPP funds through a fintech lender than they are through a traditional bank. And so the authors basically point to, this automation, this technology that automates the process can reduce the biases that we see in face-to-face lending. So overall, I think if we look at the historical pattern of data, it looks that like introducing technology-based lending actually does give us some wins.
Great. I actually saw Jay with a big smile on his face. So this is a very opportune time to ask Jay how Zest AI is helping consumer lenders make more effective and fairer decisions in the context of loan decisions and credit decisions for consumers. Can you explain a little bit for the audience what the role is of AI, and how do, maybe again, based on your specific experience, how the outcome has changed at lenders who are applying your solutions versus, again, the days prior to the involvement of Zest?
Sure, Ingrid. So we help lenders of all sizes make use of AI in credit decisioning, and that's a particular challenge because AI models typically are viewed as being black boxes that can't be explained and that can't be controlled to make them more fair. And so we've developed a series of technologies that open up those black boxes, explain to consumers why they're being denied, and also allow lenders to search for less discriminatory models that will be more inclusive of people of color and women and other protected groups. And so those technologies have enabled our customers, which tend to be big banks and credit unions, to improve the equity inclusion of their lending businesses, increase approval rate for women 30%, for example, Hispanic and African-American applicants by 30%, while managing to keep their risk constant, which was quite difficult to achieve, but something that we're very proud of, all while increasing approval rate overall, maybe 15 or 20%. And so by making use of better math and more data about the consumers who are applying for loans, we're able to say yes to more people and say yes to more people of color.
Great. Another example we have here is Sam representing Kabbage. Kabbage is now under the American Express umbrella, I think acquired by Amex about 2 years ago, and providing a whole host of solutions, whether it's cash flow management, funding, etc., for small businesses. I think the focus is on the US here. Sam, from your perspective, what is the role that AI is playing in providing those solutions? How has it really changed Amex's business since acquiring Kabbage? Again, would be great to get a perspective from people on the scene.
And thanks, Ingrid, and thank you all for allowing me to join you today. It's great. I'm joining you from a very, very snowy Denver, Colorado today. So let me give you a little background on Kabbage. And look, American Express is a big organization, so I have to say at the top that I have my own opinions, and not everything I say will represent all of American Express. But from the Kabbage side, we've been serving small businesses for a long time. And the idea behind serving small businesses is it's really, really hard to identify and isolate variables in such a heterogeneous population. No one small business is alike. And so a long time ago, we sought to really understand the underlying and existing small business data. What are the actual metrics that a small business relies on every day and that we can look at to essentially construct all three statements for the small business and provide that insight back to them? So when we talk about small business data, it is distinctly different from consumer data. There's some crossover, but we're looking very intently at transaction data, so bank account information, cash in, cash out, cash at rest, and cash at work. And that can manifest in a couple of different data attributes. If you think about accounting data, payroll data, ARAP, you can think of invoicing information, and so on and so forth, even customer engagements from CRMs or rating platforms. All of that is indicative of whether that small business is growing, whether it's stable, or whether it's in decline. And if it's in decline, why is it in decline? Is this a cyclical issue because it's the downtime for the summer rafting company, or is this a macro issue related with overall economic indicators? And so over time, you've had this maturation, and I think Anna started to hit on this really well, and just, well, you had this maturation from alternative data to non-traditional data to an acceptance of cash flow-based underwriting, which is really now more broadly accepted in the financial ecosystem and community. The OCC, about a year, the Office of the Comptroller of the Currency, excuse me, the chief banking regulator of the United States, about a year and a half ago, signaled to its large regulated banks, the brand name banks, hey, we want you to use cash flow data. We want you to use cash flow data in commercial and consumer underwriting to underwrite people without FICO scores. Getting to my point, we do a really good job of underwriting individuals and the small businesses that they run without using the traditional laden FICO score. What we do exceptionally well is actually extract that individual from the business decision as much as possible. Now, there are overlaps. There is indicative data, right? If you've never paid a bill in your life, you're probably not going to pay us. But if you've had events in your personal life, student debt, medical debt, tragedy, that is not terribly indicative of your business. In fact, we find people with really, really bad FICO scores that have put the blood, sweat, and tears into their small business tend to have really great and performing small businesses. So we look at this holistically for the purpose of underwriting, but also for other virtues, such as I said, providing that data back to the small business, giving them some sort of insight into how they're progressing against goals or tactics or strategies. And we've expanded that into different aspects. So payments is an obvious one, but also checking. How do you smooth your checking and the overall service of cash flow operations? And I'll preview a little bit what we're getting into, but what we care about inside of Kabbage and American Express is lift, fairness, that extra insight, but also that proactive management of customers. You never want a customer to be underfitted or overfitted to a product, to slip out of a product because of an event. And if you look at what else Amex has done beyond Kabbage, they've invested in other data and aggregation plays such as Kodat, which is an accounting platform investment, so that they can understand more holistically where all of the cash in, cash out, and cash at rest and cash at work for a small business actually lies.
Great. So I think, we've provided a good amount of evidence here where AI has clearly been a force for the better and making progress. But obviously, I think over the last number of years, as some of the initial hype around AI has dissipated a little bit, some of the attention now has gone into some issues of, well, it's not just all good, some scrutiny around cases of algorithmic bias that have been documented as well. And so then that obviously leads to all sorts of questions around who's getting access to what, who gets more advantages, etc. So I think it would be worthwhile to dig a little bit further into what exactly is causing this. And I think there is no way to get into that without really thinking about there are two components here that play a role when we're talking about applications of AI, and Jay kind of alluded to that. There is the math, i.e. the models, which is what people oftentimes associate with AI, but very importantly, there is the data on which the models need to be trained. And so one can't really be separated from the other, and the questions are starting to come in here and start to point in that direction as well. Maybe Sam, kind of picking it up with you again, what is the role of data, and could be traditional data, could be non-traditional data versus the algorithms in creating an outcome that is going to be more equitable than without applying AI?
Right. So I'll make my big point first, which is for far too long, we've all relied on data inputs, but haven't really looked at outcomes, and that's longitudinal customer performance. And that's understandable. A lot of the laws and regulations, which we'll get into in a little bit, are very centered on how do these inputs interact with one another to produce a questionable bias or model integrity issue. So I used to work at a CDFI a long time ago, and I would manually spread finances in an Excel macro, and it was really complicated, and we'd have to enter them in, and it was a pain in the ass. And if you think about how a normal community or traditional lending institution works, they have a credit model, and it's very small, and they'll gradually expand out, adding risk and adding, in their case, benefit, but also additional data sources. If you think about how a data scientist wants to approach a credit issue, they say, what's my total population? What is the big circle of all of the data I could get, can get, maybe can get in the future? Let's go test that. and let's see where the universe knocks off. And you end up with kind of a messy blob. With that messy blob, you go conduct an experiment and you throw money out there and you see who doesn't pay you back. And over time, you'll kind of shrink your universe, your lending model, to an operational model that is, supervised and well constructed in a way that you have a large chunk of your population and you can service them in ways that other lenders maybe would have not. And it's those other ways that lenders maybe would have not been able to serve that bring into this question of, are the data, the primary data sources, fair? And that's a really important question, something that Jay works on every day, and I'm sure he'll tell you more about. How you actually, intersect all of those interesting data sources and look at them from a logical reasoning perspective. I have an easier time in small business. Does this relate to the small business? It's harder in consumer lending where you say, hey, does this educational score really relate to their creditworthiness? I don't know, you have to go test against that. But you layer this in and measure against the outputs. And the measurements that we're looking at are, yes, longitudinal customer performance, but also the probability of default. And if you think about what that means, what it means that the probability of any one protected class, sex, race, whatever, that they should perform in the negative, so default at an equal rate across your model, thus saying that, look, your treatment of these folks is equal in the worst of events. Do you know where everybody starts in their economic situation? No. So it's kind of hard to measure the advancement there. And we've looked at some independent studies over time. FinReg Lab is a really great one where we submitted our data to FinReg Lab with a bunch of other fintech lenders, and they found that cash flow underwriting, this broad multivariable nonlinear application of modeling, is an independent predictor across all of the protected classes, as to say it scores risk as close to as you can score risk in the real environment. Now, we'll talk a little bit more about fairness as an objective, but it is possible between the inputs and measuring outcomes to optimize for fairness. So as to say, there are so many lingering aspects of unfair treatment in our society. Look at the credit laws, they try to address that. You can try to correct that in your model, and that's very much an emerging state of play in the industry. And I'll pass it on to our next guest to explore that a little bit more deeply.
So Jay, given the amount of time you spend digging through the data, how do you make sure that your data blob is one that in and of itself is equitable, right? Because obviously, ideally you collect as much data as possible about the entire population. Population may not be complete. You may have, incomplete info about parts of it. How do you make sure the data itself isn't biased? Are there ways to de-bias? How do you guys deal with that?
Yeah, I think it's a very deep question, right? So our credit data, the data that most models are built on, that FICO is built on, that any bank model is built on, reflects past lending practices. And unfortunately, past lending practices have been biased. And that bias is perpetuated by the models that then are built based on those past lending practices. So in order to predict whether someone will repay a loan, I use data about people who have gotten a loan before and who have successfully repaid. And so if we're only giving loans to white guys, then I'm only going to have data about white guys in my data set by which to make these predictive models. And so that sort of sets up a data problem that we need to find ways to overcome. Sam mentioned cash flows as one way to overcome that data. So we can take a look at people who are outside of the traditional lending products and see what's happening to their businesses or to their checking accounts and make inferences about their creditworthiness from there. The good news is that our algorithms have developed to an extent such that we can now automatically check for biases in data. So we can review every predictive variable that we're using to make that assessment of creditworthiness, automatically determine whether or not that variable is in fact a proxy or a stand-in for race and ethnicity, and whether or not using a variable in a model might lead to discrimination. Likewise, as we're building those models, we can set up our models such that they're optimizing for dual objectives so that we're not just trying to find the population that's going to repay at the highest rate, but we're also looking to make sure that the outcomes are fair to everyone who's applying. And so by making our models be less single-minded in the training process and to consider multiple objectives, we can drive to fairer outcomes. Finally, once we do have a model, we can analyze that model and understand its impact on protected groups. So we can look at what is the difference in approval rate associated with people who are applying from different ethnic backgrounds. Also, we can look at what is the implied accuracy of the model disaggregated by these different groups. And so we can really, if we focus on it and really pay attention and put effort against trying to be more fair and to ensuring the models reduce disparity or reduce bias, we can make quite a lot of progress.
I think this is a nice, moment to kind of take a little bit of a step back. We've kind of juxtaposed a little bit, like you either have humans making decisions or you have AI making decisions. But what is really, the interplay of the two here, because neither one is obviously perfect. It kind of dives in, or it kind of like jives a little bit with a question from someone in the audience as well, saying, parent disparity could be due to a couple of things. There may be latent, maybe unconscious bias amongst humans making lending decisions, or the humans may be picking up things that, because of either lack of the data or, not a fine-tuned decision of the algorithm, it isn't being captured. So AI may play a role here, but humans may potentially be additive here. How do you successfully combine man or woman and machine? Anna, you've done some research around that. Could you shed some light on that?
Yeah, sure. So yeah, the interaction between the algorithm and the human is a critical one. And as you alluded to, they both have strengths, they both have weaknesses. And so in an ideal world, we capitalize on the strengths of each and mitigate the weaknesses of each to produce the best outcomes here. So how to do that? That's the big question. So let me take a step back and talk about what we're trying to mitigate here. And when we think about discrimination, there's really two different types. There's statistical discrimination and there's taste-based discrimination. And statistical discrimination happens because there are statistical differences between groups. And sometimes lenders make decisions based on those statistical groupings. So for example, minorities may be more likely to live in certain zip codes that have lower incomes. And so they make a lending decision based on that group-wide statistic rather than the characteristics of the individual, him or herself. Taste-based discrimination is, slightly more overt. That's where a lender sees two identical borrowers. They're the exact same credit quality, and yet charges a higher interest rate to one borrower because of race or sex, etc. And so we want to be cognizant of these two types of discrimination and how we might mitigate those types. There's some perception by some that machines do better at reducing taste-based discrimination because they don't have feelings. So they don't have, they can't necessarily hold discriminatory beliefs. I think Jay alluded to this nicely, which is, well, we're feeding it with data that is based on human decision-making. So it's not necessarily the case that machines are perfect at reducing that taste-based bias. And so that's where sort of making sure that we debias the data that's going into these models is really critical. And if we do that appropriately, then we might expect that the machine does better because it doesn't have emotions. On the other hand, algorithms are particularly good at recognizing patterns in data. And so the more data we give it, the more the decision is going to be based on patterns. In other words, it's higher likelihood that we may exacerbate statistical discrimination here. So, how to combine the human and the algorithm, that's a difficult question. But I think it's pretty clear that we need a well-intentioned, a fairness-focused human involved in several stages of the process here. So debiasing the training data ex ante, Obviously, guiding the model, so a supervised model, and then looking at outcomes ex post and making any adjustments as necessary. So that's where I do have some work in this area. I have a recently published study where I look at the role of the human in making adjustments after the algorithm has produced a prediction here. So we partnered with a small fintech company that is in the business of producing credit scores for businesses, and they use a supervised model. And basically what we did is we took a set of lenders and we assigned them to some of the loans and said, hey, after the algorithm has produced a credit score, use your discretion to make some adjustments ex post. And then for other loans, we just left it as the algorithm decision. Now, we were able to run a horse race between these two models. And what we find, perhaps unsurprisingly, is human plus algorithm outperforms algorithm alone in terms of profitability and reducing credit risk. But what was perhaps a little more insightful is this is particularly the case for really small businesses, opaque businesses, where we might expect more minorities to be, minority-owned businesses or behind those loans. So this again suggests a very critical role of a fairness-focused, well-intentioned human in augmenting a machine-based algorithm.
Great. Maybe this is another good point to deal with a couple of the questions that have come in, because we're talking here about, potentially fine-tuning. There's some questions related to how do you really measure that? And you can look at it from multiple perspectives. You can either say, okay, the better outcome is the one where, there is a higher representation of minorities, or you could look at it from the perspective of the lender saying, I made better decisions because now I got fewer people defaulting because we clearly made suboptimal decisions in the past. How do you guys think about it? Like, what goes into the objective function to make a decision here about outcome A was better than outcome B?
Yeah, I'll take a stab, Ingrid. So look, I mean, I think kind of the problem is both are bad, right? So a model that's a very fair model might be one that approves everybody. Okay, so you apply for a loan, you get the loan, but that's going to trap people in a cycle of debt that they can't repay. And so we saw, during the 2008 crisis, the deleterious effects of granting loans to people who couldn't repay. And I don't think we want to live through that again. And so, while we would like to be more inclusive in our lending practices, we have to do so under the guise of not creating a train wreck for those consumers that we're going to give the loans. And so when we look at measuring fairness, we look at it from both lenses. Am I being more inclusive, but am I being responsible about my inclusion and making sure that the people that are approved are able to repay? The second sort of issue that comes up in lending in particular is that in many cases for consumer finance products, it's illegal to collect race and ethnicity at the time of application. And so you can't really even know someone's race, ethnicity, or gender just on the basis of what they're self-reporting when they apply. The notable exception there, of course, is mortgage, where we have the Home Mortgage Disclosure Act, which compels lenders to collect demographic data when you apply for a mortgage. But outside of mortgage, we don't know. And so we have to we have algorithms that estimate race and ethnicity. And at Zest, we're developing new algorithms that are even more accurate. And so to a certain extent, our lenders are their hands are a little bit tied because they don't even know the backgrounds of the people who are applying. The third issue is understanding why the model made whatever decision they made. So it made. So if the model's making a decision on the basis of an input variable that's highly correlated with race and ethnicity, you might say that the model has more inherent bias or demographic bias than a model that wouldn't do that. And so it's really important to be able to have the right mathematical framework to analyze the model's decisions, to understand what's driving any difference in outcome for protected and unprotected applicants. And so we at Zest, we use the tools of the mathematics of cooperative game theory that were developed in the 70s by Nobel Prize winning economists to analyze the model as if it were a game and to attribute the contribution of each of the variables to any difference in predictive outcome. So that having that information then allows the human reviewer that Anna was talking about to be informed and have all the information that they need to be able to police whether the models that the bank or the financial institution is building are in fact responsible, fair, inclusive, and as accurate as they need to be to move into production.
Great.
I'd also,
oh, sorry, go ahead, Sam.
Yeah, real quick, I'd also add, that's a great question that many in society, particularly the regulatory and the policy community in Washington, are grappling with. Define fair. What exactly does that mean? Lenders in many cases are caught between dueling missions from regulators that says, hey, we want you to provide more credit access. But you also have safety and soundness regulators that say, we don't want you to overextend the book. We don't want you to make potentially risky investments, credit investments. And so define fair. That's a very much an ongoing discussion, I think, both internally to banks, and there's, as Jay mentioned, there's a huge opportunity there when you begin to de-bias your source data and look at other opportunity. Can I extract additional value from what would otherwise be fair applicants if I can get a better understanding of how to score them, and can I test that? So there is very much a both expanding your universe here with people that would otherwise be sound credit decisions, in addition to, what are the partnerships there? And I see a couple of questions about, where do third parties come into this? What are the resources available to this? And to Anna's point, where humans plus machines make the best decisions, there is a real conversation about where does high tech and high touch need to come together. If you look at an example like Our Fair Share, which took Kabbage and Square through PPP lending and coupled them with real on the ground physical human resources to get people through PPP applications, that was a really effective use of resources, molding them together. One of the things that lenders can do is to use machine learning to point at where can I truly automate my credit decisions and where can I free up resources, human resources, intervention resources, third-party partnership resources, CDFIs, whatever, to focus on folks to mature them into an area where they could be, eventually an autonomous credit decision.
And this maybe gets to the point of what is the highest value add for all of the components we're talking about here, right? AI, data, etc., providing a tremendous amount of scale, the humans really doing what humans do better, which is not collecting data and trying to sift systematically through them. We started already talking about regulation, talking about DC, talking about policy, etc. Let's not forget we're talking here about finance. There is no finance without regulation. I think, Jay also made some comments about on the back of, the great financial crisis, there's some other considerations that obviously came into play. There are a couple of regulations on the back of Dodd-Frank that are now very relevant. So I think it would be good to maybe educate the audience a little bit, sections 1071, 1033. Sam, maybe you want to walk through that a little bit, and what does that mean? Does it, make AI, has it a positive impact? Has it a negative impact? Has it a little bit of both in the context of applying AI to get to better outcomes?
Yeah, absolutely. So one of the questioners in the chat asked if, how do open banking laws help with a lot of this? So that is Dodd-Frank 1033. For any of our European guests, this would be very similar to PSD2. What 1033 says is basically it asks this question that then goes to the CFPB to make regulations. What data do you consumers or small businesses own? And what data can you permission to fintechs, banks, third-party aggregators to give you a better deal, right? Better access to better compete and provide, as we talked about, that greater kind of bubble of underwriting opportunity. The answer to that is we don't totally know yet. It's going through the regulatory process with the Consumer Financial Protection Bureau, but will likely end in some sort of prescribed regulation that gives some sort of data right a data standard, and liability, which we don't need to talk about right here. That data right should provide a greater competitive aspect for individual consumers and small businesses to permission their transaction data, information that they've built either by paying their credit card bills or paying their vendors or just constructing a safe and sound financial life over a period of time, and let them go out into the world and either shop it around competitively. You think about like using a kayak, but for your finances, or just give them greater access to products and services that are more tailored to them. That very much should open that available data. It also begs lots of interesting fairness and equitable questions from that. Do different communities that are maybe not fully online, do they have the same access? Well, probably not, but there's a real policy question that follows that. How can we get people into the digital economy? Cash is very important, but moving forward, it's going to be incredibly important that data and transactions are recognized in a readable format. So translate that to 1071. Why is 1071 here? What is that? That's Dodd-Frank 1071. 1071 says that for the purpose of small business underwriting only, that lenders will need to provide a report to the CFPB that gives basically all the key aspects of the loan. So, the price, the time of the loan, the asking bid, all of these things, as well as demographic data, so race, sex, other protected class attributes, and the pricing of that. And the Bureau is going to collect that information and look at that from a fair credit enforcement opportunity and say, look, we're either going to publish research to say what's going on and are people perfecting this, or use that for enforcement actions. And I'll stop there with the overview and let Jay and Anna pick up on what some of the implications could be for the industry there.
Yeah, Jay, maybe if you can pick it up here, and also, what do you think a regulator, what do you think a policymaker can do to make some changes that would allow AI to make further progress on the positive side, but then we obviously need to have some checks and balances in place here as well. It also raises a lot of questions about who's ultimately accountable. Going back to your comment at the very beginning of, we can't have this thing be a black box and then everyone waving their hand and say it wasn't me who's responsible for an outcome that may potentially go into the direction of creating some, algorithmic bias or scrutiny or whatever. And where do we ultimately go with that? And then we can, Anna would obviously love to get your perspective on that as well. And does it also mean that some of the financial institutions really, from an organizational perspective, need to change a bit?
Yeah, I mean, I think it's a great set of questions, Ingrid. So coming out of the financial crisis, the Fed, the OCC, the FDIC authored a piece of guidance called SR 11.7 or OCC 2011-12, which is the guidance on model risk management. And what that requires is for banks to provide very thorough model documentation so that human reviewers, in the form of either a second line review team, which is kind of like model QA at a bank, can review the model and independently assess whether the model is doing the right thing. And also so that regulators can come in and understand it. So that provides a framework by which we can report exactly what these models are doing, and actually helps, I think, with the adoption of responsible AI. When it comes to fair lending regulation, though, the kind of the guidance is a little bit unclear. And what ends up happening is that banks end up fearing regulatory enforcement around fair lending decisions, so much so that in some cases I've seen them say, oh, we don't want to know what's happening from a fair lending perspective. Now, hopefully that's changing with recent events and sort of the shifting political atmosphere. But there is a fair amount of fear and uncertainty on the part of the banks when adopting technologies that can help improve the fairness of outcomes, because just simply admitting that there is a fairer alternative might be seen as an admission of guilt that they were less fair in the past. And so our regulators can really help by clarifying their guidance around fair lending in particular, to shield lenders who want to adopt fairer models and fairer lending practices from the potential enforcement actions that could result from them admitting that their lending practices weren't as fair as they could have been in the past. And so I think there's a lot of progress that could be made right there, just making it possible for lenders to adopt these new technologies.
Anna, your thoughts on whether what the regulators potentially can be doing, how can we incentivize the right behavior without getting potentially into the outcome that Jay was saying, where people go like, don't ask, don't tell. And where are we in the context too of policymakers, regulators having enough of an understanding in this field to help drive the conversation in a positive way?
Yeah, so I think it's really important to recognize that over the last decade, we've seen a reduction in discrimination in the lending space for both fintech lenders and regular banks, so under the traditional model. And a large portion of these benefits have been attributed to increases in competition. So entry of more fintech lenders and competition with that traditional banking model, which is making everything a little bit more equitable. So also, portability of financial information is going to improve this as well when consumers just have more choice. So any sort of thing that the regulator can do to promote competition, I would say, is a good thing. And we've seen that over the last a decade. So we want to do this, of course, keeping in mind and being cognizant of data rights and data privacy issues. So I think one of the big issues here is that consumers don't always understand what they're sharing, how much information, what their information is going to be used for, et cetera, unless they read the fine print and really understand complex legal disclosure. More often than not, it's going to be a click if you agree. And of course, most consumers are going to click that they agree without knowing exactly what they're doing. So I think first and foremost, what we're going to need is really clear, transparent, simple to read and digest disclosure about what kind of information you're sharing and with whom. And so we need regulation around disclosure there. We also, of course, need substantive limits on what types of data can be used and how it can be shared. And then, of course, there's the issue of data security. So we need regulation in place that keeps your data secure, both at third-party aggregators and with the end user. So I think all of those things need to be in place from a regulatory perspective. But I will sort of echo my fellow panelists here and say, I don't think regulation is enough. For one, I think companies can sort of circumvent regulation. We've seen this in many cases in the past. And I think another big issue in this space is that, technology-based lending, the landscape is evolving so very rapidly and regulation is slow. So regulation is oftentimes very far behind what we're seeing in terms of movement in the real economy. And so I don't think the regulation is going to be enough to keep protections in place. I think what we need is buy-in at the organizational level. So I think you could potentially get this through, corporate cultures that have fairness in mind, that have fair and transparent use of data, and perhaps even ones that reward employees on the basis not only of, on metrics not just related to profit, but also related to fairness as well.
And a lot of that goes to how you frame your internal success metric. And so for Kabbage, we've always looked at the lifetime value of the customer. We never wanted to have an interaction with the customer of a product just to have that sale, just to offer one credit product. The ultimate win here is when we can grow with the customer over time and provide them multiple tools, not necessarily credit products, cash flow smoothing products, just insights and data to let them choose their own path, better banking tools, better payment tools to actually reduce the reliance on credit and let them grow over time. The customer that sticks with you is going to be so much more valuable and so much more productive and frankly, easier to work with when you think about that long-term lifetime value. But at the same time, all financial players in the space are yearning for rules of the road. It's not as complicated as financial actors and folks in the industry say, we want no regulation, we hate regulation. There's very much an acceptance now in 2022 that regulation is important, inevitable, and productive, because nobody can truly experiment with new types of data or classes of data or work with not very well served parts of the market without the liability concern being addressed. And where there's regulation in place to allow for appropriate, safe, and productive advancements into new communities, lenders and other financial service providers can benefit there as well. It's a balance, though. You never want to unduly subject a population that maybe has been underserved to an experiment. It needs to be a safe sandbox where they are made whole and there's no risk to financial harms. It's a very complicated question, but I think whether you're talking about open banking data, defining fairness, collecting the data for longitudinal review, as in 1071 for small business, including educational aspects in the consumer underwriting, and so on and so forth. It is really important that both industry, the government, and advocacy organizations like consumer and small business advocates work together to define what is the societally acceptable rules of the road there.
And I think that points also, and keeping in mind here, it's a University of Chicago event. I think there's a big educational component to this as well, in terms of just data literacy, because we spoke earlier as well about, on the one hand, people may not be aware about what data they are sharing. On the other hand, there might be data that could actually help them get to a better outcome. They just don't know that if someone who was making a lending decision on behalf of, their case, if they had access to that, the outcome could be different. Like, where do you get into that trade-off and the balance between oversharing and potential abuse? I think, Sam, you also made a comment earlier, like, hey, maybe there's some ties to, educational scores that could have an impact. Someone's going to have to test it, may not. At some point, someone is probably going to throw out, genetic information too. Like, we're getting into a lot of potential danger zones, and whether it's policymakers, whether it's consumers, small businesses, whether it's, the whole political framework, is there an opportunity here to just get people more aware and better informed? I see the nodding. So maybe a little bit of an open question. We are starting to run up against the time limit here. To end on an upbeat note, picking one of the questions here again of the audience. What do you see as some potential avenues for AI in finance, especially in the spaces that you're all working in, that hasn't really been fully tapped yet? Always good to look forward as opposed to just simply looking backwards here.
Yeah, so Ingrid, to answer your previous question as well, I think permissioned and tokenized data access and the revocation, the permissioning with certain criteria on that, whether you want to call it a smart contract or use a distributed ledger technology, it doesn't matter. But the ability for customers to know what data assets they have, what they can share, where, and define for what permissible products or purposes, or for how long they can permission that, and discreetly to whom, to make sure that it's not sold or otherwise transferred to a third party, is a huge business opportunity, technology problem, regulatory problem, societal problem that's going to require lots of definition and work with all of those for students entering this space. That is very much something that I would focus on. Additionally, and very separately, one thing I'm super interested in is the green financing and climate financing. When you add machine learning questions into there, how do you define and measure carbon offsets when you're talking about home loans to put solar, or rerun piping or new water heaters? What are the measurable and acceptable outcomes we're looking for there? How can that be standardized both in the climate science community, the lending community, and the regulatory community, so that there's a productive use of capital and a productive use of machine learning to optimize for that? I don't have the answer for that, but I'm very, very curious and excited to see what's going to happen, probably very quickly, and very soon on that subject.
Anna, do you have a favorite pick?
I just want to pick up on sort of your last thought, Ingrid, and say, education is so important in this space, not only from the consumer perspective, but also from the small business perspective. I'm an accounting professor, so I encourage everybody to take more accounting classes. I often, times find that a lot of people understand the technology, but don't necessarily understand the relationship behind financial variables, which is oh so critical in this space. And so to the extent we can help consumers, educate themselves on their own data and help businesses understand the relationships between financial variables, I see that as a huge sweet spot that we can sort of capitalize on.
Final thoughts from Jay?
Ingrid, from my perspective, we're really at the beginning of finding out how we can take advantage of this transformative technology. And, Sam has had great success leveraging, transactions data in order to make a more inclusive underwriting model and underwriting business. I would love to see that data be more broadly accessible across the financial services industry. And the reality is we're really just at the beginning. And so as we start to adopt more of these technologies, make the data more uniformly available, we're going to see, I think, a real step function in terms of the equity and access to financial services. Likewise, we'll start to see use cases, not just in underwriting and deciding whether someone gets a loan, but in marketing and making marketing practices more equitable, in deciding what happens after you get the loan and whether or not they're increasing your credit line, et cetera. And hopefully we'll see a variety of new products come out that are designed to help lift people up and improve their lives as a result of being able to make better decisions using more advanced models. So I think the future is bright. I think we're just at the beginning of seeing the impact, and I think it's going to be transformative.
Great. Thank you so much, Anna, Sam, Jay. Very interesting conversation. To Jay's final thought, it's just scratching the surface. There are a whole lot of other things we discussed in advance of the panel that we could potentially tackle, but this was plenty for 1 hour. So thank you so much.
Thank you.
Thanks for having us.
Probably let me know I'm on mute. So thanks to everyone. I'll just re-say what I said, which was that the thoughts were amazing. I'm really grateful to all the panelists for being here today and talking to us about things like high tech and high touch, the human and AI, how together we can create more value, thinking about regulation and experimentation, and all the opportunities in the future for those in the industry and those soon to join it. So thank you again to all of our panelists. Thank you to the attendees. We hope you enjoyed the event today. And I wanted to share the info about 2 upcoming events for you guys. If you want to learn more about the space of AI and various societal impacts, Rustandy has a great event coming up in their social impact leadership series called AI for Social Good. And the Center for Applied AI has a conference in early April on responsible AI in healthcare. And we welcome you to both of those and hope we see you at future events. Thanks so much for joining us today and take care. Have a great week.